So welcome to the next lecture of financial institution. In today's lecture, we will discuss about the banking sector. In the last lecture, we discussed about securities, the different types of securities, the financial instruments that we had, that bond, equity and other. And then we discussed about the disinvestment. What is disinvestment? Why the government is increasing disinvestment year by year? How the changes in the objectives of disinvestment as per the decisions taken by the government. And then the Department of Disinvestment has been renamed after this budget 2016 and 17, and then we discuss the critical analysis of disinvestment. So now we will discuss about the banking sector, the different types of bank that we come across. We have public bank, we have private bank, then we have public sector bank, nationalized bank, what is payment bank, what is small banks, NABARD, land development banks. So all these are highly relevant relevant points related to the banking sector. All of us have heard the name RBI, but before RBI, let's discuss what is the role of bank, the role performed by a bank in any society. What is the function of bank? Why we need banks? Because banks performs three major type of functions. They performs the role of the bank is intermediation. Intermediation means the banks are collecting the money from somebody and giving it to the needy ones. Whoever isn't having the excess of money, whoever wants to invest their money, they will deposit their money to the banks, and banks will further give this money to the actual needy ones, whoever wants to take a loan from the banks. So actually the banks perform three types of intermediation. This is known as intermediation. So the first type of intermediation is credit intermediation. It means bank is collecting the money, it is taking the money from somebody and giving it to somebody. This is known as credit intermediation. Then bank also performs maturity intermediation. Maturity intermediation means, the maturity, in the sense the maturity of this particular loan which this bank has taken. For example, bank has this customer A and B, they deposited their money in the form of FD for 5 years. But it is possible that bank will give a loan to C, D and E, maybe for 1 year, maybe for 3 months, maybe for 2 years, maybe for 10 years, 15 years. So here the bank is performing the role of maturity intermediation. The maturity of this amount, A and B wants to deposit their money for 5 years. So 5 years is the maturity period. But the loan given by bank, it can be of 3 months, maybe to C it gave for 3 months. To D, maybe bank gave for 10 years, and maybe to E, the bank gave for 2 years. So maturity intermediation is also performed by the bank. And then the liquidity intermediation. Liquidity we discussed, there are two definitions of liquidity. The first definition of liquidity is the overall money supply in the economy is known as liquidity. The second definition is how easily you can convert any asset into tradable form without or with minimum loss of time and value. So liquidity intermediation means, suppose the bank is giving a housing loan. So the liquidity of the housing or the house is less, and suppose bank has collected the money in cash. So this bank has changed the liquidity. The liquidity of cash is more, and the bank has converted this liquid asset into less liquid asset. So the liquidity intermediation is also performed by the banks. So the banks performs three types of intermediation: credit intermediation, maturity intermediation and liquidity intermediation. We can say MLC: maturity, liquidity and credit intermediation. So these are the roles of the bank in any society. They perform such type of functions. Now we will discuss the Indian banking sector. So these roles of the role of bank is common across the world, whether it is a bank placed in USA, UK, Japan, China or in India. They will perform these types of roles. So now first we will discuss about RBI. So before discussing the functions of RBI, or this is what the banking structure of Indian economy, before that let's discuss few facts about RBI. So RBI was established in 1935 as per RBI Act 1934. Then RBI was established at Kolkata and its headquarters shifted to Mumbai in 1937. So initially RBI was not set up at Mumbai, it was set up at Kolkata and then it shifted to Mumbai in 1937, just after 2 years. It was established in 35, in 37 shifted to Mumbai. And then we will discuss, it was not established in the government sector. It was firstly established in the private sector and then it was nationalized. Nationalized means, the word nationalized is almost opposite of disinvestment. In case of disinvestment, the government is diluting the ownership from the public sector undertakings, and in case of nationalization, the government acquires any existing firm. For example, in 1969, government nationalized a lot of banks, 14 banks government nationalized. Similarly, this Air India and all, it was functioning in the private sector, Tata Airlines, and the government nationalized it, government purchased it. So the ownership changed from private sector to the public sector. This is known as nationalization. So RBI was initially set up in the private sector and it was nationalized in 1949 after independence. Then what is the financial year of RBI? Normally the financial year is from April to March, but the financial year of RBI is from July to June. It is not April to March. What is the rationale? What is the reason? What can be the reason? The reason is RBI is the external auditor of the bank, and when these banks, they will do their function, so these banks will do the internal auditing. So auditing is possible only and only if the financial year ends. So when the banks will perform their internal auditing of April to March, then they will submit the report to the external auditor, and RBI is the external auditor. So RBI will perform the auditing of time frame of April to March. And so this is the reason that the financial year of RBI is 1 quarter after the financial year of the normal banks, because RBI has to perform the auditing of this duration only. So to do the external auditing, the financial year is after 1 quarter. Then these are the basic things about RBI. Then we will discuss RBI is the apex banking institution. RBI is the regulator of all the banks and majority of the regulated financial institutions. There can be some unregulated financial institution. The role or the function performed by bank is borrowing money and giving it to somebody else. But suppose there is some unregulated one. For example, we have committee system in majority of the market. Suppose this is one market is there. In this market, there will be some shops. Suppose these shops, they have decided that every month they will give 100 rupees. Each and every shop will give 100 rupees. So finally 600 rupees will be collected. And then the committee, this market committee will decide whoever wants to borrow this money. If somebody wants to borrow, with either it is A, B, C, D, E, F, whoever wants to borrow can borrow from that committee. So this is also a type of banking activity. A committee is there and the role of the committee is same as the bank. But the problem is these committees, they are not regulated. We have chit funds similarly. So although they are regulated by the state government, but suppose even the minister of the state is involved, just like in case of West Bengal. So in that case, they are not regulated by RBI. So majority of the financial institutions, they are regulated by RBI, and all the banks are regulated by RBI. So now there is a classification of banks. First we will discuss about this classification. Then we will discuss about these things. So the classification of bank is scheduled versus non-scheduled. So schedule means the bank which has given 5 lakh rupees to the RBI, a bank which has deposited a reserve of 5 lakh rupees with RBI is regarded as scheduled bank. So 5 lakh rupees is not that a big amount. So almost all the banks of India, they are scheduled bank except 2 or 3 banks. Except these 2-3 banks, all the banks of India, they are scheduled bank because 5 lakh is not that a big amount. So this is what the scheduled versus non-scheduled. Then we have the commercial versus cooperative. So commercial means if the purpose of the bank is to make profit, then that bank is known as commercial bank. The reason of the existence of that bank is to earn profit or for commercial purpose. That is known as commercial bank. And the cooperative bank is for the development. So if you are setting up a bank for the developmental purpose, that is known as cooperative bank. And if you are setting up a bank for the commercial purpose, profit purpose, that is known as commercial bank. Now if you will do the permutation combination of these two things, scheduled from here and commercial from here, that is known as scheduled commercial banks. So scheduled commercial bank is nothing but having the features of scheduled banks as well as the commercial banks. Scheduled commercial banks, they are mentioned in the schedule 2. That is why they are known as the scheduled commercial bank. In RBI Act 1934, they are mentioned in the second schedule. So that is why they are known as scheduled commercial bank. If a bank is mentioned in schedule 2, so bank will get some positives as well as some negatives are there. So what benefits you will get if you are mentioned in schedule 2 is banker's bank. It means lender of the last resort. In case nobody is giving you loan, in case of contingency situation, suppose one bank is there, UCB, Urban Cooperative Bank, or any bank is there, UCO Bank, whatever bank. If this bank, the financial health of this bank started deteriorating and nobody is giving you a loan, then in that case, lender of the last resort, it means RBI will give you the loan. But it's not like by default each and every bank's name will be mentioned in schedule 2. If you are mentioned in schedule 2, there are some negatives also. Few conditions you have to fulfill, and these conditions are like CRR, SLR and all these things. So you have to fulfill whatever regulations they are being dictated by the RBI, you have to fulfill it. If you will fulfill all these conditions, so in case of contingency situation, RBI will give you the loan. So this is what the scheduled commercial banks are. The classification of SCB we'll discuss here. So now we will discuss the banking structure. It is RBI is there, apex, the regulator. Then we have scheduled bank. Scheduled bank again further divided into scheduled commercial bank and scheduled cooperative banks. So scheduled commercial banks, RBI has divided into 5 types. Public sector bank, which is further divided into nationalized and SBI plus associates. Recently, 2 weeks back, the cabinet allowed the merging of the SBI associates with SBI. We will discuss this thing in detail later on. But yeah, last week, the cabinet decided to merge these associates with SBI. During 1950s, when these associates they were set up, there were 7 associates of RBI. But State Bank of Indore and State Bank of Saurashtra, they were merged with SBI. So just 2 weeks back, there were only 5 associates. SBI plus 5 associates were there. And total nationalized banks were, total banks which were nationalized was 19. Within this 19, we will discuss later on. SBI plus 5 associates is means 6. So 19 plus 6 is 25. So 25 plus 1 equals to 27. These are the total public sector banks. Public sector banks means held by the government of India. The majority of the shareholding in these banks, it is the government of India. So this 25 is clear. 19 nationalized banks, SBI is there, 5 associates, total 6 gives you 25 figure. This one and this one is, first one is Bharatiya Mahila Bank, which was set up by the government, and this one is IDBI. Although in this year budget, the government has said IDBI will be privatized. So when RBI will be privatized, it will become 26 PSB. And when these 5 associates will be merged with SBI, it will become 21. So maybe in future, the total public sector banks, they will become 21. Just by accepting the acceptance of the cabinet of merging of associate with the SBI is not going to resolve it, is not going to merge it, because associates and SBI, it has been established by a Parliament Act in 1955. So you have to make amendment in all these acts. So unless and until these acts will be amended by the Parliament, not by the cabinet, but by the Parliament, we still have SBI plus associates, different thing. IDBI in this budget, government said IDBI will be privatized. So it is possible maybe by next year the total public sector banks figure will become 21. Sorry. Then we have the private banks. Can you tell me the total number of private banks, whether it is more than public sector bank or it is less than public sector banks? So of course it is much more than public sector banks. So the answer is no. The total private banks we have is 22. This 22 means 20 plus 2. These 2 means we have IDFC. Last to last year RBI gave license to IDFC, and then we have the Bandhan microfinance. IDFC and Bandhan are 2 recent private sector banks, and these 20 are the old one, the previous one. So we have total 22 private sector banks. Then we have the foreign banks. So foreign banks are very less. Can you tell me the total number of foreign banks? 5, 10, 15, 20, 25. So it is a small figure, that is only 41. So we have total 41 foreign banks. It's not a small figure. Then we have RRBs. So total number of RRBs at present we have is 56. So in the exam it can be asked, arrange the following types of bank in increasing number of total number of banks or the decreasing number of banks. So the minimum is public sector bank, the minimum is the private banks, 22. Then we have 27, then we have 41 and 56. So these are the scheduled commercial bank. Then the scheduled cooperative banks, they can be further divided into urban cooperatives as well as the rural cooperatives. So there are lots of urban cooperative banks and the rural cooperative banks. Then we have the financial institutions. Before this nationalization or before the setting up of SBI and all, there was a need of money, there was a need of performing the duty of intermediation. So at that time government set up this all India financial institutions, as well as state governments, they set up these state financial institutions. So this ICICI, before getting the license in 1993, ICICI was an example of all India financial institutions. Then LIC, UTI, all these are the examples of all India financial institutions. But the role of all India financial institutions has decreased over the year, and the role of this scheduled commercial banks has increased over the year. Then we will discuss the functions of RBI. What is the role of RBI? So it is the apex bank of India, it is the regulator of the banking sector. Apart from this, there are a lot of functions. First one is, it is government's bank. Government's bank means whether it is a union government or it is a state government, both these government, they have to maintain account with RBI. And the second thing is, whatever amount of loan, we discuss PDMA under that contemporary monetary policy topics. So public debt management agency is there, under which we discuss that at present whatever loans government of India wants to take, so RBI is the intermediate body. If union government wants to borrow something from the market, so directly union government will not borrow, RBI will borrow on the behalf of the government of India by issuing the government securities. So two major functions in the government bank. First one is, both union government and state government, they have to mandatorily open their account with RBI, and second one is, RBI borrows from the market on the behalf of government of India. Then we have the bankers bank. Even all the banks, they maintain their accounts with RBI. We discussed scheduled banks. So all these scheduled banks, they maintain 5 lakh rupees with RBI. So when a scheduled bank will be in some contingency situation, RBI will perform the lender of the last resort function. So lender of the last resort is under the second function. Then we have the supervisor of financial institution. Because RBI is a regulator, so RBI has to perform this particular function also. Then controller of credit. So controller of credit, we already discussed whether to increase CRR, whether to decrease CRR, bank rate, repo, reverse repo, all this is decided by RBI. And when RBI will increase all these things, so that is going to decrease the money supply. When RBI will decrease all these things, so money supply is going to increase. So this is what the controller of the credit. How much money, what is the liquidity of the economy, that will be decided by RBI only. Then we have the exchange rate management. What is exchange rate? Exchange rate is the rate at which dollar is converted into rupee. That is known as exchange rate. So under balance to payment, we will discuss about the convertibility norms, the current account convertibility and capital account convertibility. When you are converting dollar to rupee, for what purpose you are converting dollar to rupee? Whether to purchase any goods or services, or if you want to go and invest in India. Suppose a foreign company is coming, Amazon is coming, and Amazon wants to convert $10 into rupee. So RBI is going to ask, for what purpose you want to convert this dollar to rupee? It is, if it is for the goods and services Amazon wants to purchase, so you don't have to take RBI permission. By default you can go. But if you want to come and invest, you want to start a business, that is known as FDI, or that comes under capital account. We'll discuss all these things later on. So in case of convertibility norms, that is what the role performed by the RBI under exchange rate management. This is one sub part. The second part is that dollar will be stored with RBI and RBI will give rupee to Amazon. It means RBI is the sole, the apex dealer of forex. Whatever the forex, the foreign exchange comes, that will be stored with RBI only. Now RBI can give this dollar maybe to any this we have different shops which are converting the foreign exchange. So to this foreign exchange, these shops or these institutions, they are working on the behalf of RBI. They have to take permission from RBI. So RBI is the apex or the sole dealer of forex. Others are only agents of RBI. Then the next function is representative of Government of India in international financial institutions. So we have IMF, we have World Bank, they are the international financial institutions. So RBI represent Government of India in these financial institutions. Don't get confused here with WTO. WTO is not a financial institution. It is for the trade, to decrease the trade and non-trade barriers. So RBI represent only in financial institutions. Then we have the developmental role. So RBI also performs the developmental role. RBI persuades the bank to give more and more loan to the rural areas. Then RBI persuade to open more branches. Suppose at whatever the policy says, at least 25% of the branches should be there in rural areas. But RBI can persuade the banks to please open more than 25 branches. So all these are the developmental roles performed by RBI. Then we have the publication of report. RBI also publishes few reports. Now these reports can be annually or these reports can be monthly, quarterly, even without any time frame also. In between, RBI can publish few reports, just like RBI publishes annually. RBI publishes this report on currency and credit. So this report is annually published by the RBI. So all these are the different functions of RBI. Then the next topic is the historical evolution of the banking sector of India. So RBI is the regulator. What about the other banks? So under historical evolution, few factual things we have to cram. Just like what was the first Indian bank? So the first Indian bank was the Awadh Bank. Then the first bank set up by British. At that time it was Bombay. So Britishers, they set up the Presidency Bank of Bengal in 1806. Then they set up Presidency Bank of Madras in 1840, and they set up the first Presidency Bank of Bombay in 1843. So these were the banks which were set up by the Britishers. But first Indian bank which was set up was Awadh Bank, and it was in 1881. These three banks, they were merged. These three presidency banks, they were merged into one bank in 1921, and the name of the bank is Imperial Bank. We discussed that RBI was set up in the private sector. In 1935 when RBI was set up, it was in the private sector. So how can a private sector bank be the regulator of all the banking sector? So it means from 1935 to 1949, Imperial Bank of India, which was set up by the Britishers, this bank was the regulator of the banking sector of India. It was only after 1949 when RBI was nationalized, RBI became the regulator of the banking sector. But prior to this, Imperial Bank of India was the regulator of 1949. And you know it rightly that in 1955, Imperial Bank of India was converted or renamed into State Bank of India. The question can be asked, arrange the following acts into increasing or decreasing order year. So the regulating bank, the regulating act 1949, then nationalization of RBI 1949, then SBI was set up in 1959, RBI was set up in 1935 as per RBI Act 1934. Nationalization took place in twice, first 1969 and then 1980. So such type of question can also be asked, increasing, decreasing and all. So this is what the pre-independence historical evolution of the banking sector. Next we will discuss the after independence. So after independence, the major event was nationalization. It means changing the ownership from private sector to the public sector. So what was the need? First we will discuss the need during that time. At that time there was no trust in the banking sector, because today a bank has opened and tomorrow the bank will shut down, the bank will run away. So there was no trust of the general public in the banking sector, and when there is no trust, there will not be any saving in the economy, because banks, they are the backbone of the saving. If there is no bank, the savings of that economy will be almost zero. So bank provides that particular thing, and if there is no trust of the general public in the banking system itself, so the savings, they were getting affected. So the banks were nationalized. This was the first reason, to increase the trust. Then to lend more. Like government cannot dictate to private sector, government cannot tomorrow dictate to ICICI that you have to open 70 branches in this particular rural district of this state. But yeah, the Ministry of Finance, because all these public sector banks, they got regulation, they got guidelines from two different entities. One is Ministry of Finance. So all public sector banks, they have to perform developmental role as well as the commercial role. For commercial purpose and the overall purpose, RBI will give you the guideline. But for developmental purpose, Ministry of Finance will give you the guideline. It is mentioned in their respective act. For example, SBI, so in 1955 act it is mentioned. For other nationalized bank, it is mentioned in 1969 or 1980. Somewhere it is mentioned that you also have to perform the developmental work. So think about this, one ICICI which don't have to perform developmental work. SBI has to perform the developmental work, and both are working in the same environment. So this is also one of the reason that the public sector banks, they are not performing well. All this we will discuss about in the reforms. PJ Nayak committee was set up. PJ Nayak committee gave a lot of recommendations related to this only. Anyways, so to increase the trust and more branches, to open more branches in rural areas, to increase the credit in rural area. So all these were the reasons, these was the need of that time, and because of that only Government of India finally decided to nationalize these banks. So in 1969, 14 banks were nationalized with a paid up capital of 50 crore. Then in 1980, 6 more banks were nationalized with a paid up capital of 200 crore. So the figure of nationalized bank should be 20, but I said the total nationalized bank is 19. So how come it is 19? Because earlier it was 20, but in 1993-94 a bank was there, New Bank of India. So that New Bank of India was merged with PNB. So ultimately we have only 19 nationalized banks today. But the actual figure, the actual banks which were nationalized, it was 14 in 1969 and 6 in 1980. Recently also RBI gave license for the private sector. For the private sector, just for the comparison purpose, for the private sector, 500 crore is the capital required. If you have 500 crore, then only the IDFC and Bandhan got that particular license. Similarly, these payment banks and small banks which got license very recently, for them the paid up capital is 100 crore. We'll discuss later on. So this is what the nationalization. Then the public sector banks, we discuss the total number of public sector banks. So this we have already discussed, that RBI has classified into 5 groups. Nationalized, SBI and associates, the total becomes 25. 19 nationalized, then 6 SBI plus associates, 1 SBI, 5 associates. 25 plus 1 is Bharatiya Mahila Bank plus 1 is IDBI. So total 27 public sector banks we have. Then we have also covered the classification of banks. Then we will discuss other type of banks. What is RRB? RRB is nothing but the regional rural bank. So the name itself shows that the operations of this particular bank will be limited only to the rural areas. So 1965, Indira Gandhi felt that there is a need to enact and to pass an act from the parliament to set up special type of banks which will cater the needs of only rural areas. So as per the RRB Act, these RRBs, they were set up. And what is the procedure? What is the formula for set up this rural bank is? First of all, there will be Government of India, which is going to give you some funds, the subscribed capital. Then there will be sponsored bank. The reason of not having, or the reason of no trust of rural society or the urban society in banks is that there are chances that whatever our hard earnings, whatever we earn from last 40, 50, 60 years, that should not be wasted. So that is why there is more trust in case of government banks. Although we can say the government banks are less efficient. Now the reasons can be different, because they have to fulfill the developmental functions also. So their efficiency will be compromised. That is something different. But still, even today, the trust of Indian society is more on the public sector banks in comparison to the private sector banks. Similarly, when the banks, they are not opening their branches in rural areas, it is like there are multiple reasons. First of all, cost benefit analysis. If they will open a new branch, brick and mortar branch needs a lot of money, employees will be there, the salary will be there, but the savings of rural area is less. Now because the savings of rural area is less, so cumulatively it can be more, but they don't have that much of the financial literacy, they don't have that much of the knowledge. So if you will provide an intermediate thing, if it is a bank, if you will provide a small part of this bank whose cost is less, cost of operation, the operating cost is less, then there are chances that this bank will be able to cater the needs of these particular rural areas. So with that particular purpose only, regional rural banks were set up. So there was a need of the sponsored bank. This is a big bank, for example it is SBI. So SBI will start a new RRB. So SBI will be the sponsored bank, then the and finally there will be the state government, some share of the state government. So 50% will be given by Government of India, 35% will be given by the sponsored bank, and 15% will be given by the state government. This is how with this capital you can start a regional rural bank. But because it is at the rural area and down the line the level of political intervention, it starts increasing. If at PMO level we can say, at the union government level, the political intervention will be less. At state governments, the political intervention is more. And at the local government level, at the rural areas, the political intervention in the functioning of banks is huge. Now, RRB was only for the rural area, so the political intervention increased. To whom you should give land? Suppose an MLA is there, they will give a call to the bank manager. This is my friend, please lend 50,000 rupees or 1 lakh rupees. Even though this bank manager knows ये पैसा वापस आने वाला नहीं है, but still you have to fulfill the needs. So because of the political intervention, inefficiency, lack of knowledge and all, training of that staff, that regional rural banks, they started increasing their NPAs, non-performing assets. So what do you mean by the word NPA? NPA is nothing but, it is just a classification of your assets. We discussed the loan given by a bank is known as the asset of that particular bank. So non-performing asset, it means it is a type of asset which is not performing. So NPA means if you have not gotten any return of principal or interest for 90 days. SBI gave a loan to A and A has not returned either the principal or the interest amount for 90 continuous days, then that asset will be classified as non-performing asset. In detail, what is the NPA and all? It has been covered in economic survey. So the details of NPA we will cover in the economic survey. The rate of NPA for public sector banks, for private sector banks, for foreign banks, how it has evolved. In 1920s, the NPA rate was more than 20%. Now it is more than 5%. Still it is huge. And the government has taken few steps. What is NPA? What is substandard asset, special mention account? All these details we will discuss in the economic survey unit on the banking sector. Then the Indradhanush project that recently came. So all this we'll discuss later on. So the NPA of these regional rural banks started increasing. So the government finally decided to merge these NPAs with the sponsored bank. So the government set up more than 200 RRBs, but finally they merged together and right now we have only 56 regional rural banks. Then the next one is NABARD. So NABARD was set up in 1982 as a subsidiary of RBI. So NABARD functions under RBI. What is the role of NABARD? NABARD is just like RBI is the apex institution of the Indian banking sector. Similarly, NABARD is the apex institution or regulator for the rural banking. Very much Can you go to the office of RBI and can take a loan? No, because RBI does not involved in the retail lending. To retailers, RBI will not lend. Similarly, NABARD also don't involve in retail lending. NABARD will not give you any loan. But then what is the role of NABARD? NABARD will get some funds. We discuss RIDF, Rural Infrastructure Development Fund, maintained by NABARD. Priority sector lending we discussed. So NABARD is getting some funds, then where NABARD will use this fund, or whatever NABARD is getting from RBI or maybe directly from the government. NABARD will use it, NABARD will give to few other financial institutions. It can be the banks, it can be some other non-banking financial companies, we'll discuss later on, or it can give to anybody. But NABARD will not lend directly to the individuals. They will lend only to these financial institutions, microfinance institutions, whatever. And then these guys, they will involve in the retail lending. But directly, you cannot take a loan from the NABARD. So NABARD is also a nodal agency for the lead bank scheme. What is lead bank scheme? Under that lead bank scheme, a bank was supposed to adopt one particular village, and all the needs of the loan which are required for that particular village will be catered by that particular bank, that branch of the bank. For example, this area is there, this village is there, and there are 2 or 3 banks. So whatever bank which is going to adopt, all the needs of these banks will be catered by this particular bank. Then lead bank scheme we have, then we have self-help group bank linkage program. So for lead bank scheme, NABARD is the head. Now these are the interrelated topics that I just want to discuss. Self-help group bank linkage program. So under that self-help group bank linkage program, first tell me, what do you understand by the term self-help group? Self-help group is a grouping of 3, 4 or 5 people which have grouped together and they want to start a business. So 3, 4, 5 people, rather than taking a loan alone, we discussed in case of New Development Bank or SARC Bank, that if India will take a loan from outside, now because the rating of India is less, so India will get the loan at high interest rate. But if this New Development Bank, which has been set up by a group of 5 countries, if NDB will take a loan, then the rate of interest will be less. Similarly, if an individual will take a loan from the bank can say no. But if a group of 4 or 5 people they will take, then the risk of the bank will diversify. So maybe they will give you the loan at less interest rate. Because of this reason only, that self-help group bank linkage program was started. So SHG is nothing but an informal group of 4 or 5 people with which they want to do the business together. Then after this self-help group, we have one more type of thing that is not at all related to economics, but it is nodal NGO scheme. Before that, what do you understand by the term NGO and the total number of NGOs in India? Can you tell me a figure of the total number of NGOs? That includes registered NGOs as well as the non-registered NGOs. So in India, in a country where we have more than 33 crore gods, the number of NGOs is 33 lakhs. When I am saying we have 33 lakh NGOs, you know, there is one NGO for 400 people. This is what the density of the NGOs is. So many NGOs are there. If you are Jhola Chap NGOs, we are registered NGOs and all these things. So nodal NGO scheme which came last year, it says one NGO will adopt one particular village and all the social needs of that NGO, all the social needs of that village will be catered by that particular NGO. So this is what nodal NGO scheme is there. Then we will discuss the land development bank. Next type of bank is known as LDB, Land Development Bank. So under Land Development Bank, it is a specialized bank usually for rural area. It is a pre-independence concept of 1920s. In 1920s, it started in Punjab. So for the development of the land, these banks, they were established under cooperative societies. So under Cooperative Societies Act, these banks, they will register. So how they will land? They also have to borrow from somewhere. But because LDB, they are the cooperative societies, so their credibility is not that good. So what you need an intermediary. So usually the intermediary is the state government. So state government is giving the assurance. Whoever is lending, suppose A is there and B is there. If A and B, they are lending, so state government is giving the assurance that LDB will return whatever money you have deposited. If LDB will not be able to return, we are here. So that is LDB are getting the money when it is assured by the state government, usually. So not much successful. Land development concept is not much successful in India, but still LDB is a type of bank which is involved in retail lending. Next, the two recent ones, the payment banks and the small banks, very, very important topics from exam perspective. Payment banks, so recently RBI gave license to 11 payment banks and 10 small banks. First we will discuss what is the need of all these different types of bank. The need is, suppose this is the actual bank, this is the scheduled commercial bank. A and B are there who wants to take a loan. A and B are farmers, or we can say the individuals which don't have much access to the credit. They don't have much access to the banking sector. So A and B need some money. So one option is scheduled commercial bank can give you the loan. The second option is they will go to the money lender, the informal channel. But money lenders, there are few positive of SAB, few negatives of both. The positive is, I am discussing positive and negative from the perspective of A and B. The positive is less rate of interest. In case of money lenders, the rate of interest can be as high as 40%, 50%, 60%, even 100%. So rate of interest is high. So this is what the negative of the money lenders. Then what is the negative of scheduled commercial bank? The negative of scheduled commercial bank from the perspective of A and B is documentation. A lot of documentation will be asked from this scheduled commercial banks. In case of this money lenders, because it is their own money, so the number of documents that they require will be almost none. They will say, le jao beta, le jao, wapas to le aayenge. By whatever using their muscle power or arm twisting, whatever means, they say the documentation should be very less. It should be minimum only. So this is the positive, this is the negative. So there is a huge gap between this and this. I'm saying the rate of interest from scheduled commercial bank is 8%, 10, max to max 15%. In case of money lenders, the rate of interest, it can be as high as 100% or 50-60% is very common. So there was a need of a new institution which should fill the gap between scheduled commercial bank and money lenders. So here comes the NBFCs. Now, NBFC can be of N types, or we can say one type of NBFC, that is known as microfinance institutions. So they filled the gap between scheduled commercial banks and money lenders. But again, the problem is they are not regulated. So although they are the institutions, but they started behaving like money lenders only. Take the example of 2010 in Andhra Pradesh, hundreds of farmers committed suicide because these microfinance institutions, they were charging as high as a 60% interest rate. So because of that, they committed suicide. So they started behaving like money lenders. So there was a need of any regulated bank whose cost of operation is less. Why SCB is not going here is because the cost of operation of scheduled commercial bank is very high. So there was a need felt for starting a new type of bank whose cost of operation is less, cost of functioning, working and all is less. That is why RBI came up in 2011. It came up that we will give license to new types of banks. So finally the payment banks and small banks, they got license in 2015. So the broad need of payment bank and small bank is same, but because there has been set up two different types of bank, so accordingly the features of payment banks and small bank will be different. So the small bank is nothing but, it is like a normal bank whose area of operation is less. That is what we have, small bank. Maybe for 4 districts, 5 districts, 10 districts, these small banks will work. Then the area of operation of payment bank is huge. They can work anywhere. It is more and it is less. Then the eligible promoters who can open it, the payment banks and small banks. In case of payment banks, the eligible promoters, it can be individual, it can be NBFCs. So rather than having unregulated NBFCs, allow them to take license so that RBI can regulate them. Then we have one more thing that is known as PPI. PPI is nothing but prepaid instrument providers. Prepaid instrument providers, it is like MobiKwik wallet, Flipkart wallet, Airtel Money. All these, they are regarded as prepaid instrument providers. The problem of these prepaid instrument providers is they don't return back your money. If you have deposited 100 rupees, you have to consume it usually. The second thing is they don't pay any interest. So these are the negatives because of which the prepaid instrument providers, they have not been successful in India. Then PPI, they can take license in the form of payment banks. Then we have retail chains. So retail chains, they are also allowed to open a payment bank. So they filed the application. Finally RBI gave only the positive note for only 11 payment banks. Then who can open a small bank? It can be individual having a 10 years experience. So different classification is there. Then NBFCs also can open this small banks. Then the second thing is, what are the features? The feature is, the positive thing of the payment bank will be, if you are allowing a payment bank to open it, so if this retail chain has taken a license, so when you are going for a shopping, for example, you goes to Shopper Stop and Shopper Stop has taken license, just an example, although Shopper Stop has not got any payment bank license, but when you are going and when you are paying for your shopping, similarly you can pay for your electricity bill, water bill, because Shopper Stop will be having access to all this information if Shopper Stop will got the license of payment banks. So at one point only you will be able to do multiple types of transaction. This is one feature. The second feature of this payment bank, the second need of the payment bank is that is going to decrease the transaction of currency. More than 12% of Indian trade is being done in currency only, and when currency will be printed, there will be wear and tear. So the largest, India is the biggest, India is a country where the largest transaction is done in cash. It is 12%, which is a huge number, and a lot of cost is there for wear and tear of currency. It's in tens of thousands. So to decrease that cost, you have to incentivize, you have to provide the platform that yeah, this is there, payment bank is there. Suppose a small company is there having only 4 employees, A, B, C and D. So this company, rather than paying in cash, if a payment bank is there in the area, so this company will deposit the salary in this payment bank, from where A, B, C, D can withdraw. But because scheduled commercial banks, they don't have any offices because of operating cost, so they cannot open in these areas. This company will not open an account in scheduled commercial banks, so they will pay in cash only. So to disincentivize the flow, the rate of cash, it is a good mechanism. Then in case of, suppose one person is there. Before that, tell me the difference between NEFT and RTGS. NEFT is National Electronic Fund Transfer. RTGS is Real Time Gross Settlement. NEFT is nothing but every hour. Suppose you want to transfer your funds from SBI to some other bank, or from your SBI to your friend's ICICI. If you want to transfer the funds from one bank to the second bank, you have two options, either NEFT or RTGS. In case of NEFT, there is no minimum limit. It is zero, more than zero of course. So 0 to the limit is nowhere mentioned in the RBI Act. But majority of the banks, they keep the limit to 10 lakh. In case of RTGS, it is more than 2 lakh and there is no maximum limit. This is what the one difference. Then RTGS, I am saying real time. It means the moment you click that submit button, money will be transferred from your account to the destination. In case of NEFT, it will be done in batches. It means at 9 o'clock, then at 10 o'clock, 11 o'clock, every hour there will be transaction which will be done by the RBI. So every hour transaction will take place. So these are the small differences between NEFT and RTGS. Suppose you want to transfer the money from your account to your friend's account, which is there in, and you are in Mumbai and your friend is there in Delhi. What is the charges of NEFT? It's 10 rupees, 12 rupees, or at max 15 rupees. Suppose a poor person is there, which is in Maharashtra, and a labor is there, transferring some money from Maharashtra to Bihar, not through this formal channel but through this informal channel, because they don't have bank accounts, and Maharashtra as well as the family of this labor don't have any bank account in Bihar. So the only option they have is to send the money through informal channel. Maybe some friend is going, friend's friend is going or something. So in that time there is a lot of commission, and that commission is as high as 10%. So suppose they want to transfer just 10,000 rupees. So 10% of 10,000 is 1,000 rupees. So it is the duty of the government. We are a socialist country. The government should provide a platform to the rural folks, to the poor folks, so that they will not be forced to give 10% of their money to the middleman. This is what, how to avoid it? Open one payment bank here, open one payment bank here. Just do the transfer, online transfer, and your family can withdraw using maybe ATM or through this payment bank. So this is possible. So this was also one of the reasons. Then the features of the small bank, are same, just like this. But one more feature of the payment bank is they cannot give loan. They will only accept money, A or B. It is just like the enhancement of prepaid instrument providers. They will collect money, invest in the government securities, from where they will get 8 to 10% interest, and from here they will give you 4% interest. So present prepaid instrument providers, they are not paying any interest. To avoid, and they are not returning your money, you have to consume it. So to bypass this prepaid instrument providers, and at present they are not much regulated, to increase the regulation and all, RBI came up with this payment banks. So payment banks, they are the consequence of the prepaid instrument providers, and small banks, they are the consequence of the failure of regional rural banks. So here whatever the prepaid bank, whatever the payment bank is there, payment bank will keep some commission and will give back some interest to A and B. But the characteristic is no bank, payment banks cannot lend any money. So they cannot give you any loan. And when they cannot give you any loan, so can they issue debit card? Yes. Can they issue credit card? Answer is no. Do they have to fulfill the target of CRR, SLR and PSL? Tell me, do they have to fulfill CRR? Answer is yes. Do they have to fulfill SLR targets? Answer is yes. Do they have to fulfill PSL target? The answer is yes. No. The answer is not yes. It is no. Why it is no? PSL is certain percentage of the net lending which you have to give to specific sector. In this case, there is no lending. So when there is no lending, there is no concept like priority sector lending. Anyways, such small questions can be asked in the exam. Can payment banks issue debit card? Can they issue credit card? What is the paid up capital? So for both, paid up capital is 100 crore. Who can open it? What is prepaid instrument providers? So all these small questions can be asked. In case of small banks, all this is there. CRR yes, SLR yes, and PSL yes, with one condition: 50% of the loan should be of less than 25 lakhs. Otherwise, a big company, maybe Infosys, will start a BPO in some rural areas and will take a loan from the small banks. So the actual need of setting up of small bank was to overcome the shortcomings of regional rural banks. They were not able to fulfill the targets. So the loan amount should be less, because the poor people, they need less amount of loan. So the condition is 50% of the total loan which is given by this small banks, it should be of less than 25 lakh amount. The next, the PSL target is 75%. Ordinarily, the PSL target of the normal bank is 40%, but for them the PSL target is 75%. And 50% of the loan that you are giving, it should be given for less than 25 lakh rupees. Then we discussed all these things, payment banks, small banks, we discuss. The next will be non-banking financial company. What do you understand by the term NBFC? NBFC is nothing but, it looks like a bank, it behaves like a bank, all the functions are like banks, but they are not banks. They are not scheduled bank, they are not non-scheduled bank, they are not commercial banks, they are not cooperative banks. All the functions are same, but they are not banks. They are not registered with the RBI. The example of NBFCs, it can be microfinance institutions. Microfinance institutions, we discussed Mithod Microfinance, SKS Microfinance. So microfinance institutions, they cannot be involved in the retail borrowing. A, B, C, they cannot directly deposit their money with these microfinance institutions. Earlier, there was a distinction between microfinance institutions, deposit taking and non-deposit taking. But after this 2010 crisis of Andhra Pradesh, now RBI is the regulator of microfinance institutions, and RBI has decreased the number of deposit taking MFIs. And more than 99.5% MFIs, they are non-deposit taking. So you have to register with RBI, and the minimum outlay, just like we discussed, the paid up capital of 1969 was 50 crore, 1980 was 200 crore, the private banks was 500 crore, payment bank and small bank is 100 crore. Similarly, if you want to register, it is 5 crore. Microfinance institutions, their capital should be 5 crore. Again, it is further divided, 2 crore also. For housing MFI, it is different. For other MFI, it is different. Not much relevant from exam perspective. But 99.5% of the MFI, they are non-deposit taking microfinance institutions. So from where this MFI will get the money? MFI has to behave like an intermediary. So first they will take a loan from scheduled commercial banks. Maybe they got at some 10%. Then they will keep some commission. Maybe the commission is 8%. And then they will lend. Whoever wants to take it, they will give a loan. So this is what the role of the microfinance institutions. Then we have factoring NBFCs. Now factoring NBFCs is a very good concept, which actually caters the need of the MSME, micro, small and medium enterprises. Suppose one MSME is there, and the credit worthiness of these small companies is not good. So banks avoid lending to these micro, small and medium enterprises. And this MSME is producing something, and this is the client. So they are selling something, and that selling will involve the invoice of that amount. So a new body is required, and that new body is known as NBFC factoring. A special type of NBFC is there, and a special factoring act came in the parliament in 2011, and RBI also classified a special type of NBFC known as NBFC factoring. Now what will be the role of this NBFC factoring is, they will see कि MSME is selling to someone, they will not check the credibility of MSME, because the credibility of MSME may not be good. They will see the credibility of the client. If suppose MSME is a company which is making this small components of a very big company. Suppose this company is Maruti, your client is Maruti. For Maruti, you are making a very small component, but still the credibility of Maruti is huge. This invoice, whatever money which is being owned by this client, will be returned back to MSME, that is for sure. So what this NBFC factoring will do, they will collect this invoice from client maybe after 3 months, whatever the time duration. But in the meantime, they will give whatever this money which belongs to MSME, which this client promised will return you after 3 months, and will keep some commission. So by checking the credibility of the client, that is in this example it is Maruti, this NBFC gave money to this MSME. Otherwise the problem is the credibility of this MSME is not good. So how to increase the credibility? They can increase the credibility by selecting those clients whose credit worthiness is good. If the credit worthiness of this client is good, this NBFC factoring will give a loan to you, and after 3 months they will collect that particular money. We discussed that commercial bill, firm A is there, firm B is there, there is a risk, so firm A will give to PNB, and from PNB it can go to RBI. That we discussed. Bank rate was there, rediscounting facility against first class securities. That is not first class securities, but similar to that, this is the concept. In that monetary policy chapter we discussed. So NBFC factoring is there. Then we have housing. Related to housing also we have PNB Housing Finance. It is an NBFC. Then we have the merchant banks. So the merchant banks we will discuss in capital market chapter. The role of the merchant banks is. Then we have chit funds. So all these are the different types of NBFC. So non-banking financial companies, now there are few features of this NBFCs. The features are like the liability. First feature is the credit creation capacity. They don't have credit creation capacity. Why they don't have credit creation capacity? Because they cannot accept the money from the retail sector. They can only lend. So they don't have credit creation capacity, that we discussed in the money chapter. So they don't have credit creation capacity, and whatever deposits they have, they are collecting money from maybe some banks, they are borrowing money from banks, that is not insured. Whoever is lending to this NBFC, that is not insured. But in case of scheduled commercial bank, lender of last resort is there. So RBI will insure that particular some amount of whatever you are borrowing. In case of these NBFCs, no insurance is there. Then we have, there is lack of transparency. How they function? So these are the few features of the NBFCs. Then there are few positive things of NBFCs and there are few negative things of NBFCs. The positive thing of NBFC, they create the innovative financial instruments. It is like no bank provides loan to buy the second hand vehicle. No scheduled commercial bank in India provides such financial instrument, that if you want to purchase a second hand vehicle, you cannot avail a loan from the bank. But NBFCs will provide you the loan, that even if you want to purchase a second hand vehicle, you can take a loan. Of course the loan amount is less, but that is very beneficial. That is as per the needs of the society. Then the cost is really less. The cost at which you are getting the money is less, because scheduled commercial bank is not going to lend you. The option is through the informal channel, the money lender. So that is the cost of interest will be very high. Then this factoring services and all these are the positives of the non-banking financial company. Then the negative. The negative is they are also involved in intermediation, borrowing somebody and giving you. And then RBI has to control the monetary policy. RBI has to regulate the monetary policy. RBI has to increase or decrease the money supply. But if RBI don't have the picture, now these NBFCs, majority of these NBFCs, they doesn't come under this RBI. So if they are not even coming under RBI, RBI don't have the data, how much money is there in the economy. And when RBI don't have the data, RBI can only regulate the banking sector. They cannot regulate the NBFC. So suppose money supply is high and RBI wants to decrease the money supply. So it is not possible unless and until these NBFC, they also decrease the money supply. So on one hand, the money supply is decreasing, and when the money supply is decreasing, the rate of interest is going to increase. The rate at which the bank will lend is going to increase. But suppose this NBFC is having some old money, some stored money is there. So this NBFC will decrease the rate of interest. So more and more borrowers, they will borrow from this NBFC. So the effect which RBI wants to do, RBI wants to decrease money supply, will not be very successful. So there are a lot of hindrances which these NBFCs can create in the regulation of the monetary policy. Also in the case of regulation also, they create a lot of hindrance because they are not regulated. They don't register with the RBI, and when they will not register, think about the market committee. This market committee is nowhere registered. No registration of these committees, but they are also involved in the intermediation process. So these are the major features of the banking sector of India from the perspective of exam. In the next lecture, we will discuss about the reforms, different reforms which has taken place in the Indian banking sector. We will discuss about the Narsimham committee. Then we will discuss about the recent one, the very recent one, MCLR. Then marginal cost of fund based lending rate. We will discuss. Then we will discuss about the PJ Nayak committee, the recommendations of PJ Nayak committee. Then we will discuss about the Basel norms, Basel 1, Basel 2, Basel 3. All these different topics we will cover in the next lecture. Thanks a lot.